What's going on, investors? Stock market's doing its usual volatility, but this is actually an amazing time because we get to buy some high quality companies at a cheaper price, and we also get a higher starting dividend yield. That means we can get that yield on cost rolling much quicker. So the stocks I'm going to mention here today are either just great dividend stocks, they could be on a steep discount, or they could just be a growth company at an attractive price. Of course, I won't have time to do a deep dive on each of these companies, but if you'd like to see that for any of these stocks, just let me know in the comments below right before you hit that like button. Say no to censorship, and let's get started. So the first company we're going to talk about is Target. Now, I don't need to tell you anything about what the 8th largest retailer in the US does, other than some people actually pronounce this company Target. Target is down almost 20% from its 52-week high, and its PE ratio is now back to being under its 5-year average. At a time where the market PEs are well above 40, Target at 16 looks like a bargain. This is a company that posted a $15 billion improvement in revenue since C19 started, going from $78 billion to $93 billion. So this is a company well equipped to benefit from all the various alpha, omega variants that keep popping up every single day. Also, it's Christmas shopping season. So you know what that means for Target, right? Yep, that's right. We will be hoarding all that toilet paper from the shelves. And with 53 straight years of dividend increases, you too can join that list of toilet paper hoarders. Next stock we have is Salesforce. Now, Salesforce does not pay a dividend, but you don't need dividends when your stock is up over 261% in the last year. Salesforce is a cloud computing company that manages customer information. Its Customer 360 platform offers other applications such as sales, customer service, marketing, and commerce. Salesforce was one of the first companies to deliver software via the cloud. They even offer blockchain technology, which everyone definitely knows is the future. It currently has over 150,000 businesses as customers. Most of its business is subscription-based, meaning that's typically guaranteed money every single month like a rent check. They are still led by their founder CEO from 1999, and he has seen the company balloon to over $21 billion in revenue this past year, compared to the just $7 billion they made just 5 years ago. Look at this amazing trend line of revenue. Now, I've personally used Salesforce in my career. It's a very useful tool and was very well liked in the office among my peers. Just some anecdotal data there. Some anecdotal data history I'm glad I don't have is with Medtronic stock, which makes medical device equipment. MDT is well below its 200-day moving average of $123 and near its 52-week low of $98. This is a company that's had somewhat flat revenue growth over the past couple of years, and the reason why it's on such a nice discount is because shares have plunged over 6% in one day when it was revealed that the FDA had sent a warning letter to their diabetes business headquarters in California for having inadequate specific medical device quality system requirements. That's potentially big news, so I can understand the reason for the free fall. Nobody wants to hear that a healthcare company isn't being as diligent about maintaining their facilities, but MDT has said that they're already on top of it and working with the FDA for corrective actions. Medtronic operates in over 140 different countries and is a leader in medical technology. Medtronic has already pledged nearly $3 billion in research and development on working on a new pipeline of products and approvals. According to their latest quarterly guidance, they expect organic revenue growth of 7 to 8% over the next year. Medtronic can also continue to expand by taking minority investments in companies or completing mergers and acquisitions. Medtronic has a buy rating from 17 out of 22 analysts, and they have no sell ratings from any of those analysts. Its consensus price target of $139 means there is potentially nearly 38% upside from the share price that it's trading at right now. Did I also mention that Medtronic is nearly a dividend king with 44 straight years of dividend raises? All right, this last stock has been absolutely trampled on by the market, and that is PayPal. PayPal, of course, transacts digital and mobile payments from consumers and merchants, and its Venmo app is very popular to conduct peer-to-peer transactions. PayPal is trading well below its 52-week high of $310 and its 200-day moving average of $256. PayPal doesn't pay a dividend, But even with its recent slump in share price, it is still up over 380% in the last 5 years. This popular fintech company should continue to soar in our digital world as they are accepted by 75% of the largest 1,500 businesses in the world, and they also have a partnership with Amazon starting in 2022 where Venmo and its 80 million users can now make digital payments on Amazon's marketplace. And also, let's just take a look at this amazing chart of revenue growth. It's in a very nice up and to the right motion, going from $9 billion in 2015 to well over $21 billion this past year. Also, look at this rising cash flow numbers, up to $5 billion in 2020. I wouldn't be surprised if they do one day pay a dividend. It also has great exposure to this growing fad of buy now, pay later, with over 10 million consumers using that option this past quarter. Its acquisition of Payday in Japan was a huge deal. For just under $3 billion in cash, that gives them great exposure to the world's third largest e-commerce market in Japan, which happens to have a $5 trillion economy and a population well over 125 million people. Online shopping in Japan has tripled in the past 10 years, going to over $200 billion. That means PayPal can now just get a small sliver of all those transactions. PayPal is a buy from 33 out of 41 analysts, and just one doubting Thomas analyst thinks that it's actually a sell. Its consensus price target of $282 means there's potentially a 48% upside on the horizon for PayPal stock. Alright guys, I think I gave a good mix of dividend stocks and growth stocks that might be at attractive prices. Of course, just because a stock went down, that doesn't necessarily mean it's undervalued, and just because a stock went up, that doesn't mean it's overvalued. That decision of what a stock truly should be trading for, that ultimately lies in your hand. I'm just bringing some stocks to your radar. Now, I do videos like this all the time. Make sure you subscribe to the channel and hit that like button to help out a small-time YouTuber. Remember, my videos are always found in podcast form under the Collect Cash podcast name. As always, don't forget to buy, stash, and collect cash.